The long-awaited Fed Reserve rate cut has finally happened. Last week, the Federal Reserve announced a 50 basis point cut in their rate, signaling the beginning of a downward cycle in interest rates. So what is the Federal Reserve rate and how does it impact lending? The Federal Reserve rate is an interest rate set by the Federal Reserve that banks use to lend one another money. So although this doesn't have a direct impact on, say, mortgage rates, it does have a direct impact on auto rates, home equity lines of credit, credit cards, things of that nature, and an indirect impact on 30-year mortgage rates. So what does this mean for homeowners? Well, for starters, over the past 2 years, people that have been purchasing homes have been making those purchases at or around 7%. The Federal Reserve rate cut signals a decrease in those rates and an opportunity for people that have higher mortgage rates, specifically government loans being FHA and VA, to potentially refinance, drop their interest rate, and save some money. So this would also be an opportunity for potential home buyers to increase their affordability. With rates now starting to make their way down, they can afford more house. So the question that I get often now is, where do we go from here? When is the right time for me to refinance? Should I refinance now if rates are going to continue to slide? That's the million-dollar question. No one truly has the answer to that. What I think is going to happen is I think that this is going to be a long, slow decrease of rates. So, for example, when the Federal Reserve announced that rate cut last week of 50 basis points, a lot of consumers thought that was going to be a direct impact, half a point reduction in rate. And that just hasn't been the case. In reality, what has happened is that the market has pulled back a little bit. So what I mean by that is rates have actually ticked up just a little bit. And so, although I don't expect that to continue, I guess the point there is that there's not a direct correlation between what the Fed does immediately versus what the impact is on 30-year mortgage rates. So if you are a homeowner and you purchased a home within the past 2 years, say the second half of 2022 to present, chances are you're around 7%, if not higher. If it was a government loan, FHA, VA, you could very easily be, 7.25, 7.5. There is an opportunity for people that have purchased within the past 2 years to get some relief in payment. Is it the right time to do it now? Should I wait so I don't have to refinance twice? There's no blanket answer for that. Everybody's affordability and financing are a little bit different. If you're at 7.5, 7.75, and you can get your rate down a 1.5, there's a lot of savings there. What you do with those savings could impact you financially moving forward. You could create a reinvestment strategy to add some of that savings back into the mortgage to pay it down faster. You might be barely getting by and have been waiting for this. If that's the case, then absolutely you should consider looking at that opportunity now. I don't look at things black and white in terms of interest rates. Some people, it makes sense to refinance at a 0.5 to 0.75 of a point. Some people, if their finances are better and they can wait, if they can afford to wait, maybe it does make sense for them. But that's not a blanket answer for anybody. That's something that you want to have a conversation with your loan advisor, go through those details, be open and honest about what you're struggling with, what your goals are, short-term, long-term, and create a game plan or a solution that's tailored specifically to your life.